Hello, welcome to our monthly performance monitor. My name is Barney Hawkins, Investment Director at True Potential. As we look back over the first 3 months of the year, it's market volatility that stands out. So I'd like to begin by looking at some reasons to remain confident over the medium to longer term. The global economy is continuing to enjoy synchronized growth, albeit with countries at differing stages. The US is in late cycle, coming to terms with monetary tightening, but enjoying strong corporate earnings growth. Japan, at the other extreme, looks set to retain its program of quantitative easing for the foreseeable future, but is also reaping the benefits of economic reform. The UK and Europe lie geographically and economically somewhere between the two. The US remains popular, despite the escalating war of words between Washington and Beijing. Valuations appear full, but are being supported by corporate earnings which are continuing to come through. Twin trade and budget deficits are a cause for concern, as is the potential for a trade war with China. However, a weakening dollar will help boost trade, and most of our managers remain positive. In Europe, valuations are cheaper. The outlook for corporate earnings is more subdued than in the US, and uncertainties surrounding Brexit and the aftermath of the Italian election are affecting sentiment to some degree. However, Europe is behind the US in terms of its recovery, and so provides an opportunity to extend the business cycle. In addition, the fundamental attractions of Europe represent a more defensive play in the event of further market turbulence. Japan, too, represents a means of tapping into growth in the global economy and should hold up well, buoyed by attractive valuations, economic reforms, quantitative easing, and inflows of foreign capital. Emerging markets are likely to be volatile in the face of rising US interest rates, but they're on modest valuations compared to their developed market counterparts, and India is increasingly in focus as China matures and begins to slow. By contrast, the UK has long been out of favour with international investors. Despite attractive valuations, uncertainty over the course of Brexit negotiations and what life outside the single market will mean have encouraged investors to watch from the sidelines. However, the UK is now emerging as a non-consensus trade, with some managers increasing their exposure, viewing the UK as a defensive market and sterling as an undervalued currency. While trade wars and geopolitics remain a concern, the key focus remains on inflation. US consumer confidence is strong, unemployment is low, and Trump's tax reforms will add further stimulus to an economy already firing on all cylinders. In response to the expectation of stronger growth, the outlook for interest rates has changed markedly since the early part of the year. Markets now expect 3 to 4 rate hikes in the US this year, and a further 2 rises in 2019. This is the normalization that we've spoken about previously. However, it's important to remember that while the major economies are enjoying synchronized growth, they're not experiencing synchronized monetary tightening, and opportunities remain. Corporate earnings are pulling through and provide a useful counterbalance to the valuation worry and the upward shift in bond yields that is taking place. As interest rates, which are still at emergency levels, and global growth, which is accelerating, realign to some sort of equilibrium, volatility will be a natural consequence. And that's what we're seeing now. Events which perhaps should have happened in 2017 have occurred in the beginning of 2018. Being adequately diversified is now more important than ever. But with some of the froth blown off valuations, markets should be on a firmer footing, looking out to the medium term. Thanks for listening, and we'll see you again next month.